Start, man.
Okay, thank you. Good morning, students. Welcome back to TREI Society Accounting class. In last session, we have discussed about bookkeeping and accounting. So first chapter, that is bookkeeping and accounting. We have learned the definition of accounting and the bookkeeping, difference between bookkeeping and accounting process, accounting cycle, the various advantages and disadvantages of accounting. So today in this session, we are going to learn about generally accepted accounting principles. So Gaap. So accounting principles, it is very important to acquire the knowledge of accounting. The accountant must know the principles of accounting. So what is accounting principle? Gaap, generally accepted accounting principles, is a commonly recognized set of rules and procedures designed to govern corporate accounting as well as financial reporting. These are the set of rules designed to govern the corporate accounting in order to prepare the corporate accounting and for providing the financial reporting to the users. This Gaap is a comprehensive set of accounting practices that were developed jointly by the Financial Accounting Standard Board and the Governmental Accounting Standard Board. Both Financial Accounting Standard Boards as well as the Governmental Accounting Standard Boards, both together, they have referred to these accounting principles. So they are applied to governmental and non-governmental, non-profit of accounting as well. This set of rules are applied to governmental as well as non-profit accounting as well. So these principles, when it becomes principle, when it is accepted by all, when it has a specific reason to prove. Hence, these rules are proved and accepted. It got universal acceptance. So, in order to satisfy the criteria of these principles, so we have to uh, satisfy the criteria like consistency, relevance, reliability, and feasibility. These principles, to be satisfied, we have to follow the criteria of consistency, relevance, reliability, and feasibility. So consistency means that all the information should be gathered and presented the same across all periods. So consistency means stability. Stability, no change, unchanged set of rules. So if we are following any method, that method is applicable to all the periods. To all the periods, that we have to apply the same method to all the accounting periods. For example, if we are following straight line method for depreciation, providing depreciation, we provide depreciation for fixed assets. In order to know the true value of asset, we provide the depreciation to fixed assets. So in order to apply the method of depreciation, the accountant has to choose one method. So that is either straight line method or diminishing balance method or sinking fund method. So these are the methods, various methods. Accountant has to choose one method. He has to maintain consistency. He has to maintain stability. The whatever the method he is applying, that should be stable, unchanged. So next is relevance. Relevance means that the information presented in financial statements should be appropriate and assist a person evaluating the statements to make educated guesses. So what is relevance? Who needs information? The accounting users, external users as well as internal users use the accounting information. They need the accounting information. So in order to get the information, they need the relevant information. So whatever the information is related to them, that they need. So accountant must provide relevant information to the users. So for example, if they wanted to know about the assets, value of assets of the organization. So accountant should provide the complete picture of assets, the value of assets of organization. The next is reliability. Reliability means information provided should be trustworthy. The users should rely upon the information that is provided by the accountant. He should trust, he should believe whatever the information provided, they can believe or and depend upon that information in order to verify and take decisions. So the information should be reliable, that is trustworthy. And feasibility. The next is feasibility. What is feasibility? Feasibility is implemented without complexity or cost. So feasibility means accessibility. Easily one can apply the method. So the method that we are applying, the accountant applying, should not be clumsy. It should not be difficult to follow. It should give crystal clear information. So that is feasibility. Following the method of accountancy, the method applied should be feasible. And so these are the generally accepted accounting principles. Under accounting principles, it is categorized into concepts and conventions. Accounting concepts are the necessary assumptions, conditions, or postulates upon which accounting is based. So these concepts are assumptions. That is, assumptions means certainty of an event to happen. Assumptions means certainty of an event or transaction to happen. So we have to assume that the thing is going to happen. The conditions or postulates. Postulates are set of rules upon which accounting is based. So the concepts, these provide assumptions, conditions, and postulates upon which accounting is based. Whereas accounting conventions are customs and traditions guiding the preparation of accounts. So both together, concepts and conventions are the principles of accounting. We have 9 types of concepts. We have 9 concepts. The first one is economic entity concept or business entity concept and dual aspect concept, going concern concept, money measurement concept, cost concept, accounting period concept, accrual concept, matching concept, and realization concept. These are the 9 concepts of accounting principles. Coming to the first concept, that is economic entity concept or business entity concept. The accountant, what is business entity concept according to this concept? Business is treated as a separate from the owner. The proprietor or the investor or the owner of the business has no relation with his personal affairs are not at all included in the business. The accountant must keep all of the business transactions of a sole proprietorship separate from the business of owner's personal transactions. The accounting system gives information only about the business and not its owner. The proprietor is also treated as a creditor for the business. Though business is owned by the proprietor, he should show the business related transactions in business point of view, not according to the proprietor's point of view. With this concept, we record separate transactions even if the proprietor draws amount from the business. Even if he is drawing any goods for his personal use, we record the transaction that some goods are deducted from the purchases. Goods are reduced from the business. We record the transaction that goods are going out of the business. If he is drawing amount for his personal use, then also we write owner's drawing account data to cash is going out of the business. So with this concept, we have to treat the owner separate from the business. This is regarding economic entity concept or business entity concept. The next is dual aspect concept. Dual aspect concept is the basis for double entry system of bookkeeping. Dual means two here. Two aspects must be considered while recording the transactions. All business transactions recorded in accounts have two aspects, that is receiving benefit and giving benefit. So it is according to double entry system of accounting. Double entry system of accounting is introduced by Lucas Pacioli. So according to this double entry system, every transaction will have two effects, two aspects, that is debit aspect as well as credit aspect. If we take the transaction of a purchase of machinery, if we purchase a machinery, so it will have two aspects. That is, machine is coming into the business, and for that in turn we are paying the cash. So cash is going out of the business. Machine is coming into the business, cash is going out of the business. So for such every transaction, it will have dual aspect, two aspects. Next is going concern concept. Going concern. Concern means business. Going itself states that it is continuity. So there is a continuity in running the business. The proprietor or the owner starts the business with a view that his business will have continuous period lifetime. This accounting principle assumes that a company will continue to exist long enough to carry out its objectives and commitments and will not liquidate in the foreseeable future. So any person who is entering into the business, he will assume that his business is not going to end in near future. That means whatever the business he started, it is continued by his next generations. In that view, he starts his business. He is not going to end his business in near future. So this is unless and until it is closed by legal action. Legal means if he becomes insolvent, if the owner becomes insolvent. Insolvent means it is not able to pay off his debts. Then legal action takes place. Force law is enforced here. So it is with this intention that the financial statements are prepared for every period. So they show the financial status of the business every period. So with the concept of going concern, then business will have continuous period lifetime. Coming to the money measurement concept. All the transactions recorded in terms of money. So what is money measurement concept as we have discussed? So that we have to show the transactions in monetary value. There is no quality considered in the accounting. Only quantity aspect is taken into consideration. All the transactions are recorded in terms of money. In other words, events or transactions that cannot be expressed in terms of money are not recorded in the books of accounts. Receipt of income, payment of expenses, all these are recorded in terms of money. Means we give the value of money. For each transaction, we are giving the worth of that transaction amount we are showing in monetary value. So there is no place for quality aspects. If the person is suffering from ill health, there is no quality aspect considered. So it shows only transaction related to money measurement. It can be measured in terms of money. Purchased machinery, its cost is 50,000. So that worth of machinery should be taken into consideration while recording the transaction. So coming to the cost concept. So the fifth concept is cost concept. Cost concept, an asset is ordinarily recorded at the price actually paid or incurred to acquire it. The assets are recorded at cost at the time of purchase. Says that as per this concept, whatever the cost we incurred at the time of acquisition, whatever the actual amount paid to acquire the asset must be shown. So for example, if we have acquired the machinery cost for 50,000, or if we purchased any flat, 15 lakhs. So that amount we have to show. So we should not consider the fluctuations. So prices may go up. According to the market price, the prices may go up or prices may get down. So it may decrease. The value of assets may decrease, go down. So that we should not take up. The amount of actual purchase, whatever the cost incurred by the organization, that amount, actual amount paid by the organization or incurred to acquire the cost of asset, that only recorded in the books of account. This is about cost concept. Coming to accounting period concept. Accounting period is the interval of time at the time of which the financial statements are prepared to ascertain the financial performance of the business. The accounting period normally consists of 12 months, and the accounting books are closed at the end of every year, either at the end of March or December. So, what is accounting period concept? So, for each period, so statements are prepared at the end of the period. Usually, the organization follows a financial year and calendar year. The financial year of the business is starts from April 1st and ends 31st March. If they start recording transaction from 1st April, they should close the account to know the financial position by the end of 31st March. They have to prepare the final accounts. This is what the accounting period concept is. Not only that, as per the Income Tax Act, every business unit should also prepare financial statements and pay tax on profits every year. Madam, it is not getting, madam. Okay, madam, I will try now. Okay, madam. So, accounting period concept, according to this concept, every business unit, they must prepare the reports at the end of financial year. So, the financial year starts from 1st April and ends in 31st March. So, either they can take calendar year, so that starts from January 1st and ends in 31st December. So they have to prepare the reports. They should give a break to the conduct of business transactions. They should give a break to the continuity of the business and produce the final reports to the users of accounting. Coming to the accrual concept. The accrual concept is one of three basic accounting concepts. The three accounting concepts are accrual concept, going concern concept, and consistency. So these three are considered as basic concepts of accounting. As per this concept, the recognition of the transactions and events as and when they arise, that is on mercantile business rather than on cash basis. So following accounting, we have cash system of accounting and mercantile system of accounting. Under cash system of accounting, only the cash transactions are considered. Whereas mercantile or accrual system of accounting, we consider even the transaction if we are not able to receive the amount is due to pay. The amount due to receive also considered under mercantile basis. Under accrual system of accounting, revenues and expenses are recorded only if they are actually received or paid in cash, irrespective of the accounting period to which they belong. So now under accrual system, occurrence of claims, that is salaries payable due to pay for this month, is also considered. Outstanding salaries. So the salaries outstanding to pay, due to pay, it is also considered for this accounting period. So prepaid expenses. Similarly, income receivable and income received in advance are shown separately in the books of accounts under the accrual method. So this is regarding the accrual concept. Under accrual concept, we consider the transaction and events when they arise, not when they realized. So it is purely under mercantile basis. Under cash basis, only when the cash is received, we record the transaction. Under mercantile basis, the amount due to receive, amount due to pay is also considered. The next is a matching principle, matching concept, matching the revenues earned during the accounting period with the cost associated with the period to ascertain the result of the business concern is called as matching concept. So under matching concept, we have to match both revenue as well as cost. For example, if the goods costing 50,000 is purchased, cost of goods is 50,000. Out of 50,000, if we sold out 30,000 goods, the cost associated to sell these goods, it must be considered. Not all the purchases, not the worth of total purchases. That is not 50,000 we have to consider. The only cost associated to 30,000, that only we have to consider. So in order to get the generated income of 42,000, the cost incurred is 30,000. So we have to show the cost incurred and for the revenue actually realized. So this is regarding the matching concept. So revenues earned during that accounting period and the cost associated to that revenue must be recorded. The remaining unsold stock here, out of 50,000, we have sold 30,000 goods. The remaining unsold stock, this is 20,000, is unexpired cost. Means still this is a cost remaining, that it is not expired. This will be shown in the balance sheet as an asset. So therefore, according to this concept, incomes are to be identified with their corresponding expenses. So the realized revenue must be associated with the cost incurred, not on the total cost. Only the amount of cost incurred to realize the worth of goods, that must be recorded. So this is about matching concept. So matching concept, we have to match cost related with the revenues associated with the cost incurred of the business. So next is realization concept. So according to this concept, revenue should be accounted for only when it is actually realized or it has become certain that the revenue will be realized. So this means that a certain revenue signifies revenue is recognized when the services are rendered, actual sale is affected. But the organization should be legally entitled to receive the amount of services rendered. Here, actual, if the sale is affected, that only we have to consider. When the sales is actually taken place, realized, then only we have to consider. So this is regarding the realization concept. So we have discussed about 9 concepts. Coming to the accounting conventions. Accounting conventions are the customs or traditions guiding the preparation of accounts. They are adopted to make financial statements clear and meaningful. Thus, in common words, we can say that they are the practices or customs followed by accountants. So these are the considered as, conventions are considered as customs and traditions. Customs and traditions are day-old practices. So in order to give crystal clear information, in order to provide meaningful information, the accountant must follow these conventions. In order to provide, in order to give error-free data, communicate the financial data. So they also help to prepare and present the financial statements easily and make the financial statements more clear and meaningful. So we have 4 types of accounting conventions. Convention of materiality, convention of conservatism, convention of consistency, convention of full disclosure, and these are the four conventions in accounting we have. Coming to the convention of materiality, what it states, the convention of materiality means that in accounting, a detailed record is made of only those transactions which are material to the users of accounting information. The convention of materiality states, so whatever is material, whatever is important to the user of accounting, that must be provided. The significant information should be provided to the users, not irrelated matters, not unimportant matters. The rationale behind the materiality principle is that if every business transaction is recorded in the books of accounts, then it will be an unnecessary burden on accounting details. It states that we should eliminate the unnecessary data which is not required by the organization. The only important transactions, whatever the data, whatever the information is required, that only we are going to consider. So unnecessary and unimportant data is burdened. It is overburdened to the organization. It overloads the information. So it is regarding the materiality. Whatever is required, so that is recorded in the business transactions. The American Accounting Association defines materiality convention as the item should be regarded as material if there is a reason to believe that knowledge of it would influence the decision of the informed investor. There must be a reason in providing that material. There must be reason for providing that information. That whatever the information provided by the accountant, it must be useful to the investors so that they can take the decisions. They can change the policies. They may go for changing the decisions. So it depends upon the how best we provide the information to the users. The next one is a convention of consistency. Convention of consistency signifies that the accounting principle should remain consistent. So consistency means whatever the method we apply, that must be unchanged. It should remain stable. Stability. Consistency means stability. It should remain unchanged from one accounting year to another accounting year. For example, if we acquire any fixed asset and we are following any depreciation method, we provide depreciation to fixed assets. We are following any method, the same method is applied to year. The idea behind this principle is that unless the same accounting practices and methods are adopted from year to year, and comparison of accounting figures from one year to another year would become difficult, which would lead to difficulty in drawing conclusions about the progress of firm over the number of years. We are adopting same method, we are following same method, so it gives clear information. So whatever is accessible to the user, he will get the information required. So if we are adopting the same method, there is no confusion. So according to Eric Oeller, there are three types of consistencies. They are vertical consistency, horizontal consistency, and third dimensional consistency. Under vertical consistency, it implies that the same policies and practices are to be followed in preparing various financial statements. We prepare financial statements every year, final reports, that is a trading and profit and loss account we prepare, that is the final account we prepare. So whatever the reports we prepare, we should provide the information related to that. So for example, if we have provided depreciation to any asset, the charge of depreciation provided, we show it in profit and loss account. Profit and loss account debit side, the charge of depreciation. The same amount of depreciation is considered while preparing the assets. We have to deduct that charge of depreciation from the asset given, related asset. That is about vertical consistency. We have to maintain the same amount. So if we have charged 30,000 against asset, the same 30,000 depreciation related to that asset, we have to deduct it from the assets. Regarding horizontal consistency, it implies that the same accounting rules and policies and practices are followed from year to year. So horizontal means if we have prepared financial statements, follow depreciation method, that is straight line method in 2019. In 2020 also the same straight line method we have to apply. So that becomes easy for comparison. What happened last year, how much we have provided. It becomes easily accessible. So we can easily compare the reports with the last year reports, current reports to the last year reports. That is horizontal consistency. Coming to the third, dimensional consistency. It implies that the same accounting rules and policies and practices are to be followed by all the firms in the industry while preparing their financial statements. The third dimensional consistency states that, so if, for example, if the group of industries, so same kind of industries, same nature of industries, for example, manufacturing industries are there. The same nature of the group of manufacturing industries, if they follow the same method, it becomes easy for the comparison of within the group. It becomes easy for the comparison. So this is about the third dimensional consistency. So convention of consistency means we have to follow the same method. Whatever the method is applied, that must be applied over all the period. So from year to year, there should not be any change. We should not change the method applied meanwhile. So coming to the third convention is the convention of conservatism. The convention of conservatism means the convention of caution or the policy of playing safe. It states convention of caution or the policy of playing safe. This principle implies that provide for all possible losses but anticipate no profits. So business, while they should think, they should guess for the losses, all possible losses. They should not anticipate for the profit. They should always anticipate for the possible losses, not the profits. In general terms, it means that the accounting records and the financial statements of the business, all the prospective losses, risks, and uncertainties should be taken note of. Business means it is uncertainty. We don't know what happens next. So this year we are enjoying profits, enjoying benefits. We don't know what about the next year. It may occur losses. So one cannot anticipate the profits. So with this view that the business is involves in risk, uncertainties, what may happen, what may not happen, we cannot decide. So they should assume that. So always it is going to get losses. We should not anticipate profits. For that reason, we have to provide provision for doubtful debts. Sometimes there will be bad debts. Debtors will not pay the amount. Who is the debtor? The person who purchases goods from the business on credit basis is called as debtor. Sometimes he may pay the amount, full amount. Sometimes we may not receive the amount because it is a credit purchases, credit sales. So we may not receive the amount in full. If we received half amount, that half amount we should consider as bad debts. We should make a provision for that. So this is regarding the convention of conservatism. Business involves in uncertainties. We should provide always think of possible losses. The next is convention of full disclosure. The next convention is convention of full disclosure. The convention of full disclosure means that the material facts should be disclosed in the financial statements with more details. In regarding convention of full disclosure, whatever the information provided, that must be disclosed in full. For example, if we are disclosing the asset value, if any information, the user required information regarding assets of the business, we must provide full information regarding that particular asset or total assets of the organization. We should disclose means provide, we should show, we should give full information to the users without hiding any item. If the information regarding sundry debtors, not only total amount should be disclosed, but also the amount of goods secured debtors and unsecured debtors, and the amount doubtful from the debtors should be maintained. We are providing the information regarding debtors, we should show the secured debtors as well as unsecured debtors and the amount doubtful from the debtors. This is recording we are providing full information regarding the debtors. We must disclose the full information, not half information. There is no hiding of information. The idea behind this is that the financial statements are meant for external users who make informed decisions based on these judgments. Exclusion of material facts helps leads to incomplete and unreliable financial statements. We have discussed reliable statements. We have to provide reliable statements to the users. What is reliable? That must be trustworthy. Whatever the information provided, it must be trustworthy, believed by the users. You have to provide full information regarding particular data so that it helps the user to make informed decisions based upon this information provided. We should not exclude any material. We should not hide any facts. Whatever the material we disclose, that must be transparency. It should maintain transparency, crystal clear. There is no hiding of the information. So these are regarding the concepts and conventions. So we have discussed about what is Gaap, generally accepted accounting principle, and the conventions. Concepts, we have 9 concepts and the conventions are 4 conventions. So this is about the concepts and conventions. With this, I stop the class. In next class, we will discuss the next chapter, that is recording of business transactions.
Hello.